Uh, Obviously, starting with Sam and InMotion Ventures. I don't know if you could just give the listeners a bit of a sort of overview on, InMotion. I suppose how long you've been there, what your love of the job is, the focus, so over to you, Sam.
Yeah, perfect. Okay, well, in terms of InMotion Ventures, so we're the VC of Jaguar Land Rover, so a wholly owned subsidiary there. We were first created in 2016. At the time, we had a very strong mobility focus, as you would expect from being the CVC of Jaguar Land Rover, and very much looking at mobility quite broadly. I would say since August of last year, which was when myself and our new managing director joined, we took a bit of a step back and had a bit of a rethink of our strategy. And now we actually focus quite specifically within the mobility space, but have opened up a little bit into some more industry agnostic areas. So within mobility, we focus very much on electrification. So we're happy to look at hardware and software relating to the battery, charging experiences. I would say at the moment, we're focusing a little bit more on the software side. So, kind of platforms to look at battery chemistry, R&D, battery management, the charging experience, that kind of space. The second one we look at is sustainability, and we look at sustainability in a pretty broad way. So that can cover things like industrial decarbonization. Obviously, sustainability is also linked to the electrification side. Things like supply chain. We also look at some of the hardware elements in terms of broader climate tech, looking at things like direct air capture. And we've also done two investments this year into the sustainable materials side. One looking at utilizing leather scraps to recreate very premium leather is a company called Gen Phoenix. And the second one is really a biomaterials company, which uses different biosources to create vegan leathers, as an example. The third and fourth areas, the third is industrial tech. So anything within the manufacturing, supply chain, and procurement space. And we also look at automation platforms such as using AI to automate engineering design, as an example. And the fourth one is enterprise, which is quite broad. We look at it from the application and the infrastructure layer. And obviously this year has really been the year of AI. So we've been looking into that quite a bit as well.
Wow,
Um,
that's quite a
yeah,
lot.
yeah. Yes,
So
yes.
you're
So quite
busy.
broad. Yes, and we're also global, but with the size of the team, that's realistically translated into a primary focus into UK, Europe, US, and Israel. And we have scouts in the US and Israel to kind of help the investment team there as well. In terms of our stages, we are pre-seed to Series B, though I would say C to Series A is really kind of our sweet spot there. Um, and in terms of the link with Jaguar Land Rover, there's a lot of positives which we find there in terms of it's very easy to get customer validation. Is this a solution looking for some kind of problem, or is this something which you guys are kind of looking at as well? And
Mm.
Jaguar Land Rover is also owned by Tata, which has a number of kind of
Mm.
companies in there as well. So it's not just kind of one company which we're kind of asking for feedback from, and really helpful as well when it comes to things like technical validation. There's a lot of kind of engineers which we can reach out to in the kind of AI, cloud, battery space, which can really help us there as well.
And I saw that there's also a venture studio as part of InMotion as well. Is that in your remit, or that's another bit of the team, or can you tell us a bit about that?
Yeah, sure. So JLR has quite a broad kind of innovation strategy, and the venture capital side is one side of that. Separate to that is the venture studio, which really looks at kind of incubation of businesses. There's two kind of primary businesses which they've incubated so far, which is the Out and the Pivotal, which is looking at kind of different mobility modes in terms of car rental and car subscription. They sit quite separately to the CVC team.
Mm.
And then there's a broader kind of open innovation, strategic partnerships, all of the things which you would expect from a corporate.
Mm.
Um, So I'm just curious on the actual relationship with Jaguar Land Rover. Do they give you a lot of autonomy? Is there a steer from, parent or board or C-suite at Jaguar Land Rover? And I mean, would you? And I suppose that rolled into that, are you the corporate venture arm, or are you sort of the R&D for the business, or is it a mix of all of that? I mean, I suppose would be my question.
Yeah, good question. I would say one of the only things we don't really invest in is things like vehicle manufacture, which is just like very directly competitive with Jaguar Land Rover itself. I would say the level of steer we get from the business depends on the vertical. So within electrification, I think that's very much core to Jaguar Land Rover's strategy. So it has its own specific views on kind of what areas it would not consider as kind of strategically interesting. I would say for sustainability, industrial tech, and enterprise, the kind of strategic steer is actually pretty low. So there's kind of very high level areas in terms of what JLR sees as its kind of medium long-term interests. And we look to kind of understand those areas in a bit more detail, but we kind of shy away from kind of looking at spaces very core to the business because we're really meant to be looking a little bit further out. I would say in terms of CVCs, there's just such a broad spectrum in terms of how strategic you are and what levels of kind of sponsorship you need. I know that there are some CVCs which really can't invest unless if there's something tangible in place, such as a POC or some kind of commercial development agreement. I think partially because we're such early investors, I think most CVCs tend to be Series B kind of onwards. It's really not reasonable to ask for any of the for JLR or any of the startups to be really working tangibly with each other at such early stages. So that's kind of like one area which we have a lot of kind of freedom in to kind of see, okay, what's happening in the market. And maybe it's something that isn't quite on Jaguar Land Rover's roadmap or kind of view yet, and bringing those into the business.
The deal flow aspects of have you seen it dry up? Have you seen it still be very abundant? Has it been harder to find some of these amazing companies that you talk about? And I suppose within that, sort of second question, the pricing power remains with VCs, I would say, at the moment. So, are you, I suppose, how do you approach that conversation with like those 6 businesses that you mentioned, Sam?
Sure. So I guess to answer your first question in terms of deal flow, we have still been seeing a lot of deal flow, and the companies have been really great. I'd say we've been seeing quite a lot of split between very early stage companies and some at the very later stages. So we've been seeing a lot of pre-seed and a lot of Series B. I don't know if that's just us, but we just haven't been seeing that much seed and Series A this year. I think kind of anecdotally, when I've been speaking to other investors, definitely the Series A kind of stage seems to be a little bit lower this year. And I guess in terms of some of the things that we've been seeing a lot more than others, obviously just a lot of AI companies. I think we saw a lot of Gen AI companies at the application layer. I would say originally I was actually quite hesitant about this, very much kind of, is this just a wrapper? How kind of defensible is this? But I think as the year's been progressing, we've been seeing some really good companies actually within the application layer, particularly in the more unsexy industries like compliance, legal, where actually there's a lot of kind of defensibility and a bigger spread between companies who can really nail it for these use cases, and these use cases do need to be nailed, and those which are falling a little bit short. Also a lot in the kind of infrastructure layer when it comes to enterprise and kind of more AI, LLM ops, ML ops kind of pieces there. In terms of kind of valuations, I think we have seen the AI companies, just valuations, again, very similar to the highs. So we've been managing that quite carefully. And also, I think I've been trying to look a little bit more into kind of cloud native companies, so not AI native companies, but cloud native companies, but ones which have very clever features leveraging AI. I feel like the valuations for those are a little bit more reasonable. And actually, they already have really good product suites which they've developed and have a ready set of customers which they can try these features with. So I've been particularly interested at looking at companies within that space.
How can investors better differentiate between genuine AI companies and AI wrappers, given how much you've been looking into this?
Yeah, so I think it's just kind of by asking the kind of right questions and just understanding which model are you using. Is it one which you've trained yourself? Are you using open source? Are you using hosted? And just understanding a little bit kind of how defensible that is in terms of the specific inputs which you've put onto that. As a kind of base, and then in terms of what are you layering kind of on top of that, which makes it very specific and defensible, so someone just can't go to OpenAI, just create their own prompt and kind of create something themselves, as a very simple answer.
And out of that deal flow that you've seen in AI, how if you had to sort of guess percentages of wrapper versus genuine, what's the split looking like?
I think I'm seeing a lot more genuine at the moment, but I think that's because a lot of the deal flow we get is coming from other investors, and therefore they've already kind of done that first pass, which is always incredibly helpful.
That's good. And then I wanted to circle back to Chris's question on kind of the market. There was a fantastic report from Wilson Sonsini that came out, their Q3 report, and they included what the changes in kind of what's market for deal terms at the moment, and showing kind of how that's progressed. So higher liquidation preferences, more warrant cover on convertible notes, and generally an uptick in down rounds and kind of a downtick in up rounds. So yeah, would love to hear your view on kind of the market at the moment and some of those dynamics.
Sure. So I haven't seen that report. That report actually sounds really interesting. So I will go have a look at that. Perfect. So in terms of some of the kind of terms which you mentioned there, in terms of liquidation preferences, warrants, we haven't been seeing so much of that, to be completely honest. I've been seeing a lot of safes, CLNs, which are really looking to do more bridge rounds, do more kind of middle rounds, seed plus, pre-series A, and just kind of hold off pricing the round. I have seen the discounts probably be a little bit higher than we would normally see in previous years. So I think that's kind of the main thing that we've been seeing there, but we have also seen quite a number of down rounds, and that's been something where, because we don't lead rounds, sometimes we're speaking with a startup and looking at the post-money valuation compared to the traction we have, then sometimes we just need to take a bit of a pause and just see how that round is going to shape out from a valuation perspective, and whether that's going to be priced a little bit more appropriately for today's market. And we have been seeing quite a lot of that.
Have you seen a change in like focus on more profitable unit economics from previous fundraising rounds versus projections? And
yeah,
okay, interesting.
Yeah, and we've been seeing that quite a lot within the portfolio companies as well. That now there's just a very rigorous view on, okay, how are we getting to the path to break even and then profitability, and kind of measuring that against growth. Obviously, you can't kind of be in the middle of both. You can't have subpar growth and not reach profitability. So there's a bit of a balance to be had there, which I do not envy those founders for. But yeah, definitely a topic of conversation.
Seeing a preponderance of great companies coming from the UK, US, EU, Asia, or is there one region, or is it, there's good stuff everywhere?
Yeah. So great question. I think so as I mentioned, we always said that we'd focus on UK, Europe, US, Israel. We had a look at our portfolio, and it's entirely UK and US at the moment. I think our links within the UK are obviously very strong. This is where the kind of investment team sits. So we have a very good view of the UK market, and the US as well. I would say this year we've done a real push to trying to open up deal flow within Europe more, and just actually visiting Paris, Berlin, Munich, Portugal, Madrid, all of those great countries, and trying to open up that a little bit more. So we're now actually seeing quite a lot of interesting deal flow from Germany and France in particular. So that's been really great. And as I mentioned, we also have a scout based in Israel, and there's some really great kind of companies there as well, particularly as we look to focus a little bit more within the enterprise space. Obviously, everyone knows that Israel is quite strong for cybersecurity, DevOps, but there's a really great kind of ecosystem there, which we're really trying to tap in more.
On Germany and France, is there any particular themes within the deal flow that's been, kind of outstanding?
So I would say we're seeing a lot of AI from both of those. I think France is becoming a bit of an AI hub now, and seeing some really interesting kind of robotics companies coming out from France as well. I think similarly, Germany has always been really strong for industrial tech, also very strong for kind of general automotive. So a little bit weird that we hadn't really focused on it so much up until now. But yes, a lot of stuff within manufacturing, procurement, supply chain, some really interesting companies coming out of Berlin, Munich, and quite a good university ecosystem there as well.
I just want to touch on, you mentioned sort of your investor network and getting referrals and vetted deal flow from them. Who are the typical co-investors that you find? Who are the usual suspects that you're often finding in the rounds with you?
Good question. I would say perhaps up until August, when we were focusing very strongly within mobility, we were investing with quite a lot of other OEM CVCs, so Porsche Ventures, BMW Ventures, and then just the general financial investors. I wouldn't say there's any kind of one or two VCs which we're kind of consistently investing with. I would say we're very, very flexible and just end up investing with pretty much anybody. I think now that we've kind of opened up our scope a little bit more, the conversations that we're having with some investors are perhaps a little bit different than what we had before. So as an example, kind of more specialist VCs within deep tech, enterprise, data, kind of all of those kind of spaces. So I would say just very general, typical VCs, CVCs, all of the above.
So, Sam, one thing I've noticed, and you've given some fantastic insights today, and especially around InMotion, but we haven't really asked you about you. It'd be great if we could hear a bit about your background, how you got into VC, because clearly there's a lot of chat and a lot of perspectives given by different commentators on the industry about how difficult it is for women in VC, how hard it is, how few female VCs there are. So I suppose, if you could give us some background on your journey so far, Sam, would be great.
Yeah, sure. So my background's been a little bit random, mostly characterized by jumping into what I found most interesting at the time. So my educational background is in psychology. Super interesting, not very relevant, but I was just quite keen to do something interesting, and thought that the kind of study of people and why we make such illogical decisions all the time was quite interesting. So did my undergraduate at UCL, wasn't really sure what I wanted to do after that. So I actually did an internship based in Beijing within a strategy consulting, helping Western companies move into China for the first time, which I found really, really interesting. And I think from that, I always really wanted to be in strategy. I thought strategy was really, really exciting. So I came back, I did my master's at Manchester Business School in organizational psychology, pretty much half business, half psychology, and really enjoyed that. Then did a mixture of things. I did a very brief stint consulting for financial services, which did not suit me whatsoever, and then jumped into BP. So I started off in the strategy team at a business unit called Castrol, which is essentially engine lubricant. I think interestingly at the time, they realized that electric vehicles were coming, and electric vehicles fundamentally don't really need engine lubricant. So what's going to happen to this business? So I was doing an interesting bit of work looking at, okay, can we transition from being a product to a service, kind of which different new revenue streams are we going to target? And I think at the time BP had even a bit of a greater realization that it's not just electric vehicles, it's autonomous vehicles, it's sharing services. Fundamentally, the way that people are going to get around is going to be very different. Petrol and diesel revenue at some point is going to tank, and there's billions of dollars worth of real estate within these prime city locations, which BP has for petrol stations,
Trapped
which maybe
assets.
need to use for something else. If we live in a world where electric, autonomous, shared fleets are going around, they probably want to charge somewhere a lot cheaper outside of the city. So I was doing quite an interesting bit of strategy work there, thinking around what new business models should BP get into. Obviously, there was electrification, which was very natural to kind of go through there. And when I was there at the team, BP acquired ChargeMaster, which then became BP Pulse. So that was kind of led by the team when I was there, and then also looking at what other business models we could look into. I think once that piece of strategy work was done, I then did some work with the BP Ventures team, and then moved to the M&A team. M&A did not suit me so much. I think the venture side was really exciting, but at the same time, I kind of felt, who was I to judge these startups? I'd never worked in a startup. Everyone was talking about APIs and tech stacks, and I didn't really know what that meant. So then I looked to jump into a startup myself. So I joined a company called Via. Don't know if you guys heard of Via Van. So the original business model was essentially Uber, but more focused on kind of ride sharing and aggregating trips together, which was a really fun time to be working for such a company. There was intense price competition from the other competitors. Everyone was very well funded. So that was a really exciting time trying to figure out how do we make this really operationally intensive business, this marketplace, really work. And then so I joined within the expansion team. So my role was to launch these services in new countries. So I went to the US, was based in Virginia, of all places, working on the launch for one of our biggest kind of services there. Came back due to COVID, actually, because COVID was really kicking off there, and COVID obviously wasn't so great for these ride sharing companies. So Via at that time pivoted from B2C to B2B, and particularly B2G SaaS. So becoming the tech infrastructure for matching rides, kind of supply demand, as well as in the logistics space. So started working a lot there on product development in terms of the tools that we were using, making them enterprise grade ready, working a lot with the developer teams, and then just did a host of other roles within that, I guess similar to what people do within startups. So did operations, sales, product management. And then after, I think, 3 and a bit years there, Via had just grown so massively. I think by the time I left, it was worth 3 billion. There was about 1,000 employees, and it didn't really feel like a small startup anymore. So I wasn't necessarily looking to get into venture. I was looking for a role that was really going to reward me for all the different stuff I'd done. So a bit of strategy, bit of finance, product, operations. And there's not many roles which really do that. Was originally looking for a more strategic role in a smaller startup, and then thought back to venture, and kind of fell into it, and interviewed with the InMotion team, and just really liked their kind of vision and really liked the team, and joined last August.
Yeah, so looking ahead, 2024, general thoughts on, do you think we're going to see a recovery in the wider scheme of things, Sam? And I suppose, second leg of the question, what's in store for you and InMotion?
So in terms of funding, I do expect and hope that things will pick up a little bit more generally. I think, as you mentioned, there are definitely pockets of investors which are deploying quite well. I think there's a lot of activity. There's so many more interesting startups and business models which have been kind of enabled by the AI boom. And I think kind of moving forward, there'll probably be a less focus on like the tech just by itself, and starting looking at the more fundamental aspects such as go to market, and we'll kind of move into that more not state of play, but kind of the VCs will have a kind of better understanding of how things are going to be developing. So I think the funding environment, I I think and I hope that it's going to improve. In terms of what's store for InMotion and for us, I think some of the areas that we're really excited about, as I mentioned, is this kind of AI and enterprise infrastructure level. I think at the moment, enterprises still aren't really using and deploying their own AI models a lot. I think that will slowly start to change, and we'll start getting more enterprise grade tools coming out. So I think that's quite interesting. I think there's the underlying kind of infrastructure to support that, such as multi-cloud management. So if you have lots of these different AIs on lots of these different cloud providers, which all have their positives and kind of negatives, actually there's a lot of complexity which that brings in. You have different clouds, you have different assets on those clouds. They may be using AI. There'll be lots of different software developer tools associated with each one, and that will just multiply out complexity. So I think areas like that, which can help manage that complexity, will start becoming an interesting space as well. And that's one area which I personally want to focus on a little bit more. And as we see some of the kind of broader industries, so within electrification, sustainability, industrial tech, enterprise, start utilizing the kind of benefits of the more tech-driven software development best practices, I think there'll be a lot of opportunity within that as well.
Just want to say thank you very much, Sam. Brilliant insights. Really nice to talk to you. Hopefully see you at one of my events in the future, and enjoy your Christmas and everything that brings. I suppose, are you going off to Slush this week, or
I am.
Oh,
yep. Next week.
Yes, party on then. Party hard.
Yes. Yeah. It's more of a festival than a conference, but so fun.
Yes. I think the last time I went was 10 years ago, and it took me about a week to recover. So
everyone gets so ill.
I won't be going, but enjoy.
Thank you so much.
Yeah, nice to meet you.
Take care.
Cheers, bye.
Bye.